All right. Hi, everybody. This is Josh Weidman here with with Build and Grow with Real Estate Show. Thank you so much for joining us today. Today's guest is part of our Perspectives in a Changing Market series. Is Anna Kelley. Anna is a rock star real estate investor and educator and all around friend of the show and really amazing person. So we're so happy to have her today. Anna, thanks so much for joining us. How you doing today?
Thank you. It's always good to be here with you. I'm doing amazing. I love real estate, and with all the crazy talk and everything, I still absolutely love it and do a lot of it every day.
That's right. That's right. I love your Facebook posts. I mean, most of the stuff on Facebook is like the best part of your life, snipped out and airbrushed and put online. Where your posts are like so substantive. They're usually the stuff you see on LinkedIn or something with a little bit longer attention span, let's say.
Yeah.
Um, so
Thank you
I
for reading along.
well, it's fantastic. It's fantastic stuff. And if this is your first time, viewing the show or seeing Anna anywhere, I mean, you want to get on her Facebook feed, follow her on Facebook, and check out. It's REI Mom. Is that right?
Yes.
Yeah, REI Mom. I mean, she is a really, really insightful investor and also a very, very successful investor. Do you mind just kind of throw some accolades at us? Because I think since the last time we talked, your door count and your VRBO investments and things like that have really exploded.
Sure. I'll tell you just a little bit, just to kind of give you a perspective of my insights on real estate and how I think the way that I do. I started in private banking in 1997 into early 1998. And so I've been working with investments for all of my adult life. And I learned how to invest in retail stuff, right? Stocks, bonds, mutual funds, gold, annuities, etc. And
Yep.
nobody knew anything about real estate. I didn't learn anything about real estate. I didn't talk to my clients about real estate. And then I left and I went to AIG, and we put together investments for ultra high net worth individuals,
Okay.
hedge funds, onshore, offshore, et cetera. And so I got a real good glimpse of what do the wealthy do, right? And then I used real estate to create my own wealth. So
That's
while I
awesome.
worked full time at AIG for 20 years, I started building a small real estate portfolio. Got started small like many other people, singles, fix and flips, small multifamily properties. And then I decided to start doing some larger apartment buildings and really went all in multifamily until recently. I've been dabbling in short-term rentals for a few years. And because I did see some changes in the market and some changes in the things that impact multifamily properties, I've been a GP and have ownership in about 2,000 doors across the
Wow.
country,
That's amazing.
Texas, Georgia, Pennsylvania, syndicating those deals. Oh,
Hmm.
my personal ownership without syndications with myself and two partners is about 300 multifamily units in central Pennsylvania. Okay.
That's great.
But I love vacation rentals. And when you start to see markets shift, you start to look at when you put on an investor hat, not just the real estate hat, but
Yep.
how do investors look at what they're going to invest in and how do they diversify their portfolio? There's two big things that are really important. How do I diversify? You don't see anybody in one thing forever, right?
Right. Yep.
What's the market doing? How do these market changes impact the thing that I'm in? And should I start to get in, get out, add some things, take away some things, diversify? And so I started buying a lot more short-term rentals. So I have
Mhm.
short-term rentals in some of my apartment complexes, and I have luxury vacation rentals, and about a $200 million portfolio today.
That's phenomenal. That's phenomenal. Well, so my goodness, you took away my first three questions. So let's talk about, I think it's interesting to see people's perspective, um, depending on when they entered the real estate market,
Yes.
where a lot of, and then I got started in 2006, right before everything kind of, it went downhill for a while.
Yes.
And I'm a lot more gun shy than a lot of people that maybe they got started in 2015 or 2016, and they've got enough repetitions, let's say, under their belt. They've done enough deals. They've been through a lot of different situations, but that big cataclysmic, shift in the market overnight is something that's always in the back of my head.
Yes.
whenever I'm looking at something. You got into real estate and really kind of dug your way through some of the muck through the 2008 crisis. Can you talk about that a little bit and what that was like, and maybe relate that a little bit to today, if you see anything that's similar?
Sure. Yeah, I completely relate to where you are. I'm extremely conservative.
Hmm.
I bought my very first real estate thing. I bought a condo in 1999. So it was just like, hey, let's buy a condo. I'll live in it, then I'll house hack it, and then I'll rent it out and have it as a rental property. And then I bought
Yep.
a speculative house. I flipped my first property in 2003. I
Hmm.
remember because my son was 3 months old, and it was the way to start, replacing some income and
Yep.
hopefully be home with that baby. He's now 18, right? So flipped the house. It sat on the market a while. We didn't know what we were doing. And we were starting to see that properties were sitting on the market a little bit longer, but
Hmm.
really didn't understand why, right? And we moved to Pennsylvania in 2007 for my husband to start a job. And it was the height of the economy. And I see a lot of parallels today to what
Yep.
I saw in '07.
Hmm.
We came here to start a business. Everyone said the economy's booming. It's never going to fail. Never bet against America. It's only going to get better. It's a great time to take out a $300,000 loan to start a business, right?
Yep.
Great
Yep.
time to buy real estate. So we bought a mixed use building for him to practice in, and it had apartments on top and it had garages in the back. And I thought, well, this is a smart move. It gives us some extra income to cover his lease space in case he, like 95% of other businesses, goes out of business in the first 5 years. And
Right.
we house hacked a 4 unit because I knew enough. I wasn't like looking to grow my wealth in real estate. I was really just starting out I had some tenants in his practice. I house hacked a 4 unit to live below our means just in case his business didn't go well. But
Yep.
I never thought my job was really at risk. I worked for AIG, one of the largest companies in the world, right?
Yep.
Had what I thought was a very secure job. We did financial products, Josh, for ultra high net worth individuals, but also for banks and institutions, right?
Oh, wow.
So
Yeah.
we knew what they wanted to invest in and we gave it to them.
Yep.
I had my department next door worked in credit default swaps. I didn't know anything about it. And I didn't know that a combination of mortgage insurance, credit default swaps, and hedge funds would take down almost my company and the rest of the United States and globally through a combination of those things that were happening before my eyes, but that I didn't understand.
Hmm.
So I still listen to all the people that said the economy's booming, investments are booming. And I
Yep.
was blindsided by 2008. I lost most of my 401k. I
Hmm.
was heavy in financial stocks. I was at the threat of losing my job every week. People were walking out of AIG. They got a $2 trillion loan from the US government. Like, it was bad, right?
$1 trillion. It's
And
crazy.
I remember standing in my apartment like it was yesterday. I just sold this building last month, so it's still like a little emotional, right?
Yeah.
Standing in that apartment in early 2009, late 2008, bawling and thinking we tried to do everything right. We started a business, we budgeted, we lived below our means. Everyone said it was great. How did we miss this, right? I
Yep.
didn't listen to the warning signs because I was just like focused on, let's start
Yep.
a business, let's buy our things. But what I realized that hit me hard at that time is it's the things that you don't know that come to get you, not the
Yep.
things you're so certain of and so sure of. And so all the people that have certainty and surety that we've lived through the pandemic, so how much worse could it be?
Yeah.
They haven't lived through multiple things, right? We lost just about everything. The only thing that was going well was those tenants. They were still paying. Even in
Yep.
the recession, they were still paying, Josh. And I thought, how is this happening that people are laid off all over the place, but they're still paying rent? And I realized real estate is the only thing that was still going well in the recession. Now,
Hmm.
my value may have come down. I don't know. I was focused on, can they pay rent and can I survive, right, without
Yep.
a job? But it was that aha that I have to take control of my income, but I need to learn to study the economy. I didn't know. I mean, I was trained as a financial advisor. I got my 6 in '63. I didn't get my 7. I was going to get it, and then I left to go to AIG. But all that to say, I thought I knew a whole lot about money and
Hmm.
investments. I did, but I didn't know anything about the economy and the
Yep.
things that drive economies and cause massive collapses, right?
Yeah.
So I learned to study. I lived through '08. I've always been a conservative investor. And here's the thing, people that take too much risk because you hear that it's only going to get better, you can lose a lot. But I
Yep.
can tell you, slow and methodical and mitigating risk when you see warning signs still can produce a $200 million portfolio in 10 years, right?
Yeah,
I'm
that's
living
amazing.
through it, right?
That's amazing.
So
Yeah.
I'm extremely conservative. And thank God I was, because then the pandemic hit. And at the time the pandemic hit, Josh, I had over 900 units and thought none of my people are going to be able to pay. We're going to lose it all. But because we had been kind of watching warning signs of recession in 2019, we got liquid. We started being conservative. When all my other friends were buying aggressive stuff, they were hurt more in the pandemic. We were conservative. So
Yeah.
I'm very conservative. And the stuff I'm going to tell you today is like, how can we protect you as listeners to plan for the worst, think of the worst, start mitigating for it. And if it doesn't happen, you're in no worse position. But you
Right.
don't want to be a position where you just listen to all the good news, ignore the bad news, and then you get wiped out. I've been there, and I don't want anyone else to be there.
Well, and there's ways to make money in any economy. It's just
Absolutely.
making sure. I mean, I have people call me all the time, and the first thing, especially newer investors, first thing I tell them is like, there are 1,000 ways to finance an investment.
Yes.
If you choose the wrong one, it's going to sink the investment. And
Yes.
it's the same thing with whether it's an investment or a loan, it's got to match what's going on in the marketplace and what the needs are. So let's talk about that a little bit. What do you see today? I mean, obviously interest rates are going up. They're probably going to go up another half point, for the 10-year treasury next month, and probably another point or two on, in the 30-year fixed over the next couple months.
Yes.
What do you, in my head, I had 7.5% as kind of the tipping point, as the point where people see that, this is it's just too expensive to continue to pay this much for housing, and the prices may come down. What are your thoughts on that? I mean, it's just a number out of the air. I don't know what that is.
I think that's too high. And I'll tell you why, Josh, because although some people say, rightly so, listen, when I bought my first house in 2000, I think my interest rate was like between 8 and 9, maybe 8.75, 8.25.
Yep.
And I didn't blink at it, right? The economy was going well. I didn't blink. But the difference is that the housing prices today are in lots of markets double what they were in 2007.
Mm-hmm.
So if you have extremely high prices at the time that you suddenly have very high rates, when the rates have been really low for a decade, it's a real shock to the system.
Yeah.
So it's reading, I read a lot of different news periodicals that are not mainstream, right? Real data, economists sharing data.
Yeah.
And the average home price since January, the average mortgage payment has doubled since January. So in almost 5 months, double mortgage payment. So rates were 3.25 for a homeowner. I got something locked in at 3.25 at the beginning of the year. Now you're lucky to get 5. If you're an investor, obviously it's higher, but prices are still going up while these rates are going up. And so we're already seeing a huge slowdown in demand for homeowner occupied mortgages, right? And refinances. Investors are still going, but a lot of investors are freaking out. And I work with a lot of investors, I coach. And so I've got students buying vacation rentals that when they started the process, the rates were a lot lower. And now suddenly the mortgage payment's so high, they might not be able to make the debt payments and still qualify for a loan. So I think it's already starting to happen. Yeah. The question is, at what point does it happen that it makes you have a real estate crash? And that's what, people are, and maybe it's 7.5, if rates keep going up, that's enough to kick us over the edge.
Well, I just, one thing that I looked this morning, and, the 30-year fixed, average 30-year fixed is at it's at 5.1%.
Yeah. And
in December, it was 3.05%. I mean, I refinanced my house last August at 2.97 or something like that. And I thought even then we were at the verge of a rate increase or something coming up. Yes. And, and it took another, 4 or 5 months before that really kicked in. It's concerning. I guess the affordability is definitely an issue.
Yes.
And in markets like, just Georgia that I've heard of 50-year fixed mortgage rates coming out, which at 5.5 or 6%, the payment ends up being the same. I
Yes.
can't imagine that that's going to be sustainable or, become the norm. Certainly not in every market.
Yeah. It's real interesting because when I was at Bank of America, 1998,
Hmm.
we came out with the Affordable Home Act. Community Redevelopment Act, I think it was what it was called, which was one of the first things to let's give loans to people who can't afford them,
Yep.
right? Because we
Yep.
want home ownership, and there was a lack of affordability and a lack of home ownership. So I saw that turn into subprime mortgages, and then
Yep.
where all of that led.
Right.
But I can say that our governments don't learn very quickly, right? We slash rates, we raise rates. Every time we slash rates and you start to get a bubble, you end up with unaffordability. You end up with bigger wealth gaps because the wealthy know what to do with our money, right?
Yep.
And then
Yep.
you get asset bubbles, and then it collapses. And then these high rates that have to be put into place to fight inflation and bring down a hot economy, the Fed immediately lowers rates again, right? They don't learn. They might crash the system in the process, but they really don't learn. And
Right.
so they keep rates low again because we need to keep stoking improvement. What happens though is affordability has always been on the radar of our government, and it's becoming more and more on their radar.
Yep.
In the United States as well as globally. So there's a big push post-COVID to fix the affordability problem. And one of the first things I saw tangibly go into place was that Fannie Freddie conventional loans started pulling in April second home loans and investment property loans.
Yeah.
They reduced drastically the amount they'll give. They increased the rates for them. And when I read why from a housing Fed leader, they essentially said because we want to divert funds to affordable housing and start giving more money to people that we want to be able to buy houses that can't, that have an affordability problem. And they were looking at different options to do that. So
Right.
I hadn't seen the 50, but I've seen in some of these mortgage periodicals that they're looking at the 40-year mortgage as a regular conventional thing to get those payments back down low. And
Yeah.
that does keep housing demand higher. So it fixes affordability, maybe. It takes a piece of that, but it increases demand by people who can't afford them now.
Hmm.
Question is, what does that do nationally? What does it do to higher in home prices? Higher in home prices aren't going to be as impacted as strongly by those 40-year fixed programs, I don't think.
No, I don't think so either.
But I don't know if they have income limits. I assume they're going to come, at least at the conventional level, with income limits. Like once you're here, you don't get the 40-year unless you go to
Sure.
a lender like you or DSCR loan or something of that.
Well, even with that, I mean, these amortized loans are all front ended with interest.
Yes.
So, you're not making any kind of real progress on a 40, even a 40-year loan. It's
Right.
going to take you 20 years to take any kind of principal off of that loan.
Right.
So, I mean, it's almost as if you're leasing the property, but you get the repair costs.
Right.
Yeah.
Right.
Yeah.
And a lot of people realize that. They're realizing, not only, especially with inflation, not only am I dealing with rising prices, rising interest rates, but now I've got to pay for insurance and I've got to pay for lawn and snow removal and all that stuff I don't want to. And they're renting, and it's driving up rents, right?
Mhm.
So
Yep.
the gap between rents and a mortgage payment is so narrow right now that people can't get homes. Maybe the 40-year gives them enough of a gap that they start to take that bet again. But I think prices have to come down before that happens. And a lot of people think prices can't come down. I do think prices generally are going to come down.
Yeah.
I don't see a housing crash like 2008. I
I
think
don't think
in
so either.
certain markets you may be hit harder. But I also don't think that just because nationally there's more demand, there seems to be a lack of housing supply nationally. That doesn't mean that every price point, every market can't go down because there's a housing shortage.
Well, and I think we kind of live in a bubble, not the kind that burst, but like in Central PA, this is a fairly low crime,
Yes.
market. Even in some of the worst neighborhoods, they're not near what you would see as far as crime and urban blight and things like that you
Right.
might see in Pittsburgh or Philadelphia or New York or whatever.
Mhm.
So you do have plus the blue collar the amount of blue collar jobs in Central PA is very strong. It's a huge
Yes,
basis, and there's a lot going for our area.
for sure.
I don't know. So what would your take be on if somebody is looking to invest? What's the best way to go about it? You're saying, okay, well, we're probably looking for a little bit of a downturn, and it's really tough to find a really good deal, whether it's a flip or a rental property or whatever. What's the play to offset that?
Yeah. I think a couple of things just in general. When you're investing, and I'm not a flipper, so I'm going to say I lean toward long-term investing, right?
Yep.
If you're in that niche and you're really good, just get in and get good. This is the time to like get in and get out.
Yep.
You're probably not giving people 20 hard money loans at one time in this market, right?
Right. And
Um,
the big projects are the ones that are scary. If it's going to take you 8 or 9 or 12 months to get out of this loan, what's the market going to look like? I don't
Right.
know. You
Will
don't know.
values be
Let's see.
down? Will rates will be way up? Does that lower your buying pool? Right.
Right.
So I
Exactly.
don't want to be heavy in a whole bunch of hard money loans at one time, but I'll
Yep.
still use them. You just got to be really good and really nimble, right?
That's right. That's right.
Generally speaking, I want to buy investment properties that are going to weather a recession. They're
Hmm.
going to weather where we are right now with high inflation, and they're going to weather a recession because, again, I'm not an economist, but I study a lot. I believe that we will head toward recession or stagflation after inflation. We're
Hmm.
probably already starting that, but you don't know until officially after two quarters of negative GDP. So essentially, I believe that we're heading into some harder short-term economic times. The good news is most recessions don't last more than about 18 months.
Hmm.
Sometimes they're shorter. 2008 was bad and deep, right? But buy investment properties that are going to be resilient to layoffs. If inflation gets crushed with high interest rates, companies are highly in debt, in variable debt. And this
Yep.
is what a lot of people don't understand is that a lot of the companies in the stock market and that employ us, right? They have variable debt that they can barely pay now. So I think the Fed has been slow to raise and they've been warning, warning, warning. Like you went and refied your house. The Fed's going to raise rates.
Yep.
Institutional investors, big multifamily investors, corporations were starting to refi that debt or try to kick it down a little further. But if demand slows down and they still can't cover that debt, they're going to lay people off. So
Hmm.
I want housing. I lived through '08 in central Pennsylvania, to your point. My tenants kept paying. I
Yeah.
couldn't produce high rent increases and my values didn't go way up, but they were stable. They did not come down during the crash. My
Yep.
tenants continue to pay. So invest in areas like central Pennsylvania, where you've got a fairly low cost of living and a lot of jobs.
Yeah.
And you have less housing supply than you do demand in your town, in your markets that you're investing in.
Hmm.
So what happens in the market is going to affect your property. Doesn't matter how good of a deal you get on your property. If it's not in a market that's resilient, that's going to keep rents going and keep values going up over time, you're going to do poorly. So I see a lot of people just chasing yield. Deals don't
Yeah.
cash flow. So let me go to rural Podunk, Mississippi in the middle of, nothing and buy
Yep.
a house because it's real cheap and I think it'll cash flow. Well, if there's no jobs to support it, you're going to lose your shirt, even though you think
Right.
it's a safe, nice, pretty house, right? So study the market and buy recession resilient assets, things that people need,
Hmm.
not the things that are extra. Like I love self-storage, but in a really bad recession with inflation at the same time, like stagflation, people will give up a storage unit, but they still need a place to live,
Right.
right?
Right. For sure. So something interesting is happening. I think in northeastern. I think that it's interesting in northeastern Pennsylvania. You've got a lot of small towns that might be 20 miles of woods in between them, right? And they're blowing up. Property values are going up, and in a lot of these towns, we've reached a kind of a critical mass where property values are to the point where now homeowners can pull money out of the house and fix it up. And now it's not just investors that are cleaning up the areas and things like that. And I always loved that when I was investing in Philly, because it was like, you reach that critical mass and now all of a sudden you have a jump of 100 grand in a year or two in a property value. Another, well, to your point about investing in areas where, you've got a lot of good indicators of strong employment, things like that. Amazon and some of these other drop ship type companies have been adding warehouses near these small towns in the middle
Yes,
of seemingly nowhere. And it's just been interesting to see the dynamic of change where you have these steel belt, steel belt towns that are coming back and
right.
becoming great places to live, very affordable places to live that, people have good blue collar jobs. They work hard every day. They
Yeah.
come home and they can afford their rent or their homes and things like that. And at the same time, you have people fleeing some of the more densely populated areas
Yes.
because they've just gotten to a point where they're just too expensive. I mean,
Right.
yeah. So it's a good point. All right. So
Absolutely.
where are you investing? If I wanted to ride your coattails, what would what would I be looking for? I mean, you've invested a lot in the short-term rentals recently.
Mhm.
You said over the last couple of years. Do you think interest rates are too high now to find a deal there, or strike that? But I guess what I'm actually asking is, are you seeing that maybe right now for you, there are some markets where this makes sense, but generally overall, there's been so much competition in the space
Yeah,
that,
but here's the thing. I don't look at competition. I don't go, where's my competition or can the prices go higher? Because right, I'm not investing for the most part, I'm not investing for appreciation.
yeah,
Appreciation is gravy, but it's never guaranteed.
yeah,
And I've seen people that invest for appreciation with very little cash flow get killed in times like '08, right?
yeah,
So I am looking at places that are going to have some longevity and lasting power where people are always going to want to rent them from me and always going to want to buy them from me.
hmm,
And values likely won't go down for long, but that have really great cash flow. So, for example, I buy large multifamily properties. Um, our competition isn't just syndicators like me, but it's institutions who want a
yeah,
safe place to park money. And they're not worried about cash flow. They are worried about the economy. When
yeah,
big institutional investors start getting out of the stock market and buying apartments and buying them at a price that gives them a 3 to 4% cash on cash return on their money, tells you they're not buying them for cash flow. It's a preservation of capital play, right?
yeah,
So
yep,
your investors that want safety, big institutional investors are buying houses and apartments and because they want safety. They think that they're recession resilient, right? But
hmm,
there's not great cash flow there. So and the values are more impacted by interest rates. So topic for another time, but it's very impacted by the value of interest rates. Single family homes, vacation rentals aren't as much other than it prices some people out of the values just keeping on going. But
yeah,
I'll give you an example, Josh. I bought a place. There's a great report, an annual report put out by rented.com.
hmm,
Annual report that shows you the most profitable places in the country to own vacation rentals. And every year it kind of shifts a little bit, but you see some themes. The Poconos, Pennsylvania comes up on that report every year in like the top 20 to 30 places to own a vacation rental that are profitable. So
yep,
they look at not only the price point, how much are people paying, how much competition is there, but what's the cost to run them and what kind of rental income do they consistently generate. So
hmm,
Pigeon Forge, Tennessee, I drive past it every time I drive to Florida and Texas twice a year, but I've never been. So we're like, we need a place that's halfway between where my ones are in Florida and the ones are in Texas. Pigeon Forge is ranked the second most profitable place to own a short-term rental. I went to Pigeon Forge. I looked at some vacation rentals. The prices were incredibly cheap compared to everywhere else. So while I see Facebook pages, short-term rental pages saying we're overheated in Pigeon Forge and Gatlinburg. Things are 500,000 that brings 70,000 in income, and we bought them for 300 a couple years ago. I'm like, if I want 70,000 in income anywhere else in the country, I'm paying 90,000, 100,000, 1.4 million dollars, right?
right,
So if
right,
I can make, and literally, I'm making a 28% cash on cash return on a little cabin in Pigeon Forge. There were 26 offers and I won and I went way over asking, but I'm still making double digit cash on cash returns compared to anywhere else. So
yeah,
I don't care if that property in Pigeon Forge goes down in value a little bit and prices soften because I'm going to make 70 grand a year in the worst times and way more in the best times on a property that's one of the most travel places in the country, right? So
hmm, yep,
they just make sense. But if you know what average looks like, you know what your own financial goals look like. That's the most important part. Then you
yep,
know what a good deal looks like to you in this market. It's never a bad market to do a good deal.
yeah,
Invest for the long term and say, I might have a year or two of pain. Maybe my rents aren't quite as good for 2 years. Maybe the values come down for 2 years. I don't care. I'm prepared for that downturn. And I know that over 20 or 30 years, I'm going to have an amazing asset.
You know what I love? All of this conversation, Pigeon Forge, it had nothing to do with how pretty the cabin was and how nice the flowers were and the trees and all
I
that
didn't
stuff.
even go in it.
It's all the numbers, 28% cash on cash return. We bought it for this. This is what I mean. That's fantastic. I love that. I love
Yeah.
that. It
Yeah.
makes the decision. It creates a much cleaner decision making process for sure.
Absolutely. It's all about the numbers. I learned a long time ago, never fall in love with a property. Unless it's your
Yeah.
first, second home or vacation rental and you just really love it and you just want it to break even and give you some free vacations. Yes, you have a little more emotion in it, but I don't even look at the interiors. I'm like, what's the numbers that it's doing today? And I know that I can make the numbers do a lot better if I do XYZ.
Yep.
And you look at your financial goals and you look at what else is in the marketplace that I can put my money into. That's what all major investors do. They say, okay, if a treasury's at 2, I'm going to have to get more to take on the risk of a bond and take more to take on the risk of real estate and take more to take on the risk of the stock market. I do the same thing with real estate. I'm like, where are the risks in each asset class? A single, vacation rental, multifamily. What is the return it's paying me to take on that risk? And multifamily, it's 3 or 4%. If you're really good, maybe 6 right now.
Mm-hmm.
Well, it was
Yeah.
great a few years ago. So those syndicators or investors that have been doing it, like you said, since 2016, they've only seen making millions of dollars, even if you make mistakes.
Right.
Now we're at the top. You can't afford to make very many mistakes. So buy stuff that still gives you really good cash flow if you need cash flow.
Yeah.
And don't buy banking on appreciation today, unless it's forced appreciation because you're buying it dirt cheap because of the condition it's in today.
Yeah.
Buy for cash flow, even low cash flow, just move the needle, right?
Mm-hmm.
Just move the needle. It doesn't have to be a slamming, smoking deal. Most of my deals I'm doing right now are not smoking at the price, but it's the debt structure I'm using to buy them or the creative structure I'm using to get in them that's juicing my returns and making it much better. So price is not a factor to me.
So a couple of years ago, I worked at a private equity place in Philly, and one of the associates was a billionaire. He it made like $2.4 billion selling a huge property management company from New York. And long story short, he was interviewed, and they were talking to him about what's the most important thing when you're buying a piece of real estate. And he said, well, I always start with the financing. If I can get long-term, low interest, fixed rate, terms, now I know exactly what the property's worth. And
Yes,
that's so huge. And especially in a climate like we have today, where, the outlook is a little uncertain on, how high can we go on these rates? It's like lock in the debt for as long as you can at the
absolutely.
lowest rate that you can. And and if it cash flows today, well, then it's likely to in the future if you take care of it and make the right moves.
Absolutely. And the other thing is don't compare it. History is a really good lens to see trends like how low have rates been, how high have they been, and for how long. Well, if
Yep.
you're comparing today to 1979, 1980, you're like, man, this is cheap, cheap debt, right?
Yep.
If you're
Yep.
comparing it to 2007, this is cheap, cheap debt. But people are short-sighted, and we've been so spoiled by 3 to 4% rates for years, blips up but right back down, right, to keep the economy from crashing. We've been spoiled by that, so our perspective is just like these people in Tennessee that are not buying anymore when they
Hmm.
could be making another 20% on their money because they're comparing it to where prices were last year or rates were last year. If you know your financial goals and you get an interest rate that's fixed that will allow you to meet those financial goals with that deal, it's a good deal. You can
Yep.
always refinance it if and when rates will probably come back down. They always do historically. Once you hit a recession, if
Yep.
we're heading there, rates will come back down. So don't be afraid to don't pass on a really great deal that actually meets your financial goals that has fixed debt just because rates could come down. I'll just refinance when they do and cash flow a little now. And then when they refinance and hopefully values are where they are a little higher, then I'll, restructure my debt and keep on going.
That's great. That's great. My goodness. We've been here for 34 minutes.
Wow.
That went quick. That's awesome. That's awesome. So we're running out of time here. So I'm gonna thank you and ask you, to please come back because this is amazing. This is amazing stuff. If this is the first time you're hearing this, please visit Anna online at REI Mom on Facebook. Anna, if somebody wants to get some more information from you about, I know you have coaching and you raise money for some of your syndications. If somebody wants to get in touch with you, either to invest or to get more information about your coaching programs, how do they get in touch with you?
Wonderful. Thank you. So I'm on social media at Anna Kelley, REI Mom, on most of the platforms. My website for coaching and mastermind is reimom.com. And if you're an accredited investor and looking for syndicated deals, passive real estate investing, you can find me there at greaterpurposecapital.com.
That's awesome. And all this has just popped up on the screen. So, help yourself, reach out to Anna. And she's a phenomenal resource. And it's such a pleasure to talk to you. But aside from the real estate, you're just an awesome person. I love talking to you and hearing about what's going on. So, please come back and tell us how things are going in a couple months.
Absolutely. I'd love to.
That's great. If you, as we mentioned a couple times during the show, interest rates are going up. However, our rates have not gone up and we have no plans of increasing them. So if you're looking for a hard money loan, we can underwrite your loan within a few hours, get you approved and fund within 24 hours if the title work's done. So give me a call if you need a hard money loan. Otherwise, you guys go out, have a great day and go make some money. We'll be back here in the next day or two. Thank you so much, Anna. You have a great day.
Josh. You too.
All right. Thanks so much, everybody.